How are we doing? Ready? Everybody ready?
Yeah.
Yeah, good. Okay. Right, well, I'm Simon Townsend. Jeff introduced me very kindly earlier. And in this session, which may be a bit longer than most of the others, so I've got quite a lot of stuff to get through. And it may be a bit intensive, so I apologise in advance. I hope the coffee's refreshed you and it's not going to be too difficult to digest. Before we start, the small print, I'm obviously not going to go through it, but you've seen all this stuff before and we're obliged to point it out. So when you go back and review the slides, please read and be thrilled by what you see there. I'm basically going to do three sections within this. And the first thing I want to talk about may sound very obvious, but it's actually fundamental to everything that we're doing here. And that is I want to really understand what it is that moves the market. Because getting something as simple as that foundation in place actually makes all the difference in the world for what follows on from that. Second section, I want to extend that knowledge further into what I call looking behind the charts, to actually understand what is going on in the background behind the charts that we see on our screen, and understand the clues that we can read from that and give us an idea of what's likely to happen next. And then finally, I'm going to take that knowledge and translate that into 6 specific entries that you can use to get into the market. And as you can see there, we're going to cover a number of things. Some people like retracements, some people like to try and take reversal trades. So we're going to do a bit of everything here with what I'm going to show you here. Now, before we even start, I could easily cut at this point and not give you those. I know you want stuff you can take away and use starting on Monday morning, and that's great. And this you literally can pick this up and use this as soon as you get back. But what I'm going to show you at this point, I just want to emphasize here, you can apply this to anything. You don't need to apply it to the setups I'm going to show you. You can use this as a filter to help you in your own trading, to help identify some of the trades that are less likely to work out. So I know this is probably where everybody wants to get to, because that's naturally what everybody's asking for, but don't underestimate the importance of this and finding ways you can apply it yourself to your own work. Okay. Finally, if we get short on time, don't worry. We've got an hour and a half this afternoon, so I'll take any questions that we can't get in during this session. We won't forget about you, but as I say, I'm likely to run short on time. So if we've got time for questions, I'll take them. If not, we'll do that after lunch this afternoon. If that's okay. Yeah. Right, first of all, let's talk about some basics. All sorts of people look at all sorts of factors in deciding what they want to do in the market, hundreds of them. And some people apply different emphasis on all sorts of things that they think influence where a market is going to go and what is going to happen. The reality is that however many of those different inputs you take into decision making, you can never model enough of them, in my experience, for any of them to make any consistent impact in predicting what's going to happen in the future. But the one common thing between all of these is that they will only ever affect the market in terms of supply and demand. That's the one commonality between all of these different factors that a lot of traders like to look at. The market only experiences buying and selling, and people wanting to buy and people wanting to sell. And therefore, rather than getting too obsessed about some of these things which people think are important, if you actually focus on the one thing that the market actually experiences, which is supply and demand, you can effectively take advantage of all of this information that is coming in from all of the market participants, from all over the world, and not having to get bogged down in any of that detail. So that's why the whole principle that we're talking about here is trying to identify what the pressures are on the market, and therefore how the market is likely to respond, rather than worrying at all about why that might be the case. The first thing I need to just take you through is what I call the paradox, because this is something that over the years a lot of people have struggled to come to terms with, because there's an apparent inconsistency here, in the sense that we're told that for every contract or every share that is sold, there is a buyer. Buying and selling is always equal. So how come, if that's the case, markets move up and down? It doesn't seem to make sense, does it? If buying and selling is always equal, you would think that the market wouldn't go anywhere. Yet the reality is both of those facts are true. The market does move up and down, and buying and selling is always equal. Therefore, there must be some more to this than is immediately apparent. And actually, the answer is that it's all about what people want to do, rather than what people actually do. And this is where it starts to get bizarre. You're thinking, hang on, if intention actually has more effect than action, how can that possibly be the case? And I want to just walk you through the order book in order to help you understand this sort of apparent conflict of ideas. And I need, at the end of that, for us to understand that buying and selling and supply and demand are two completely different things. Now, we all use those terms fairly loosely and interchangeably, and I think I will probably do it even during this presentation today. But what I need to get across to you at the very beginning is that supply and demand has got absolutely nothing to do with buying and selling. They're completely different animals. I'm going to try and get that across in this first section. So here are some definitions that they may not be cast iron, but these are the definitions I use in trying to explain this. And I define demand and supply in these ways. The total number of contracts, or shares, or whatever it is that the units are of the markets that you're trading in, the total number of contracts that people want to buy at a particular price, is what I call demand. On the flip side of that is that supply is defined as the total number of contracts that people want to sell at a specific price. Okay, so that's intention. Buying and selling is the total number of contracts that actually change hands. Okay? So you can immediately see that within those definitions that I'm trying to separate out what people want to do and what actually happens. Now, buying and selling, as we've already said, that's always equal. But the key here is that supply and demand is rarely equal. And that's what determines movement in the marketplace. And the simple way to differentiate between these is to think of buying and selling as history. It's what's already happened. It's what makes up the bars on your price chart. Supply and demand is what has not yet happened. Okay? This is the intention that's underlying what's going on in the background that we can't yet see. And that, as I've said, that gives you a clue as to why we want to focus on supply and demand. It's because the people that have not yet bought or sold, they actually determine what happens next. Whereas the people who have already done their buying, their selling, the history they're on. They don't affect anything from that point on. Now there's a very simple order book that we will all be familiar with. What we're seeing here is the bids and the offers and the quantities available at each of those prices. So the current offer is 500 in this example, and what we're saying there is that those 43 contracts, that's the total available to you if you decide to hit a market order and buy one right now. There are 43 available, and when they're gone, they're gone. Okay, so if you're one of the first 43 people to hit the buy button, you'll get that price. Similarly, on the sell side, if you want to market order and sell, you've got 92 available there on the bid, and that's it. There are 92 available, and unless more become available, that's the limit that you're going to be able to sell at. So it's a question of, do you get there first or does somebody else? Or does someone like George come along and take all 92 and give you a cut? So what happens is that when the 43 on the offer there are taken because somebody comes along and takes all 43, or a number of people come along and actually take those 43 out, everybody else that wanted to buy at that 500 price, they're no longer able to, there's nothing left. And so this is the unsatisfied demand in the market that causes price to auction up. So you can see that what we're saying here is that with only 43 available, if there are only 43 people that actually want to take on a contract, then that's fine. But if 43 represents only a tiny proportion of the demand, then a tiny proportion of those people are going to have their orders filled. The majority are going to be left there with orders that are not filled. The market is going to auction up, but the demand is still big. So that's what pushes the market up. And similarly on the downside, it's all about how many of those 92, it's how the 92 that actually get transacted relates to the amount of people that actually want to sell. If there are only 92 contracts worth of people wanting to sell, they'll all get filled. They're fine, they're happy. If 92 represents a small percentage of those that actually want to sell, the majority are going to be left with orders that are not filled. Does that make sense? Yeah? It's simple stuff. But the importance of this is that the people whose orders are not filled are this hidden supply and demand that I talk about as lurking in the shadows behind the charts. Because those are the people that determine what happens next. Okay? Does that make sense?
Yes.
Yeah?
Yes, that's good.
So the conclusion that I draw from this at this early stage is that a lot of people talk about the importance of price charts and being able to use charts to see what's going to happen and get a feel for what's going to happen next, which there's a lot of validity to. But we have to recognise that what you see in the charts is history, and it represents what's already happened. Whereas the people who have not yet made a tick within the market that's currently forming, those are the people that we really want to try and understand who they are, how many of them are around, on what, and that gives us a clue as to what the pressure is going to be on the market for the next move, whether it's going to be up or down. And so that's why, in what I'm going to show you in a minute, we're just trying to focus on the people who have not yet had their orders filled and get a feel for the relative proportions of those guys. So that's sorry. Somebody was that my mic making funny noise? Okay, I thought somebody shouted something else. That's what moves the market. Okay, fairly basic stuff. I just want to talk about what doesn't move the market for a minute. Lots of traders get very, very bogged down in indicators, all sorts of things, dozens and hundreds of them. And there is a common misconception that indicators somehow do something to influence the market and what happens next in the market. And they don't. They don't. All they do is reflect price bars regurgitated by some mathematical formula. So what you're doing with indicators generally is you're using history to tell you something about history just in another form. Okay? So whilst indicators can have a use, they're certainly not some mystical, magical things that tell you what's going to happen next. They are simply a different way of representing what has already taken place. So I try wherever I can to steer people away from getting ideas that indicators lead things or cause things to happen, because they don't. If the market moves up, your indicators are going to move up. If the market moves down, the indicators are going to follow, and it's as simple as that. So decluttering your screens, taking away a lot of this stuff makes sense in a lot of ways, because it takes away all of those debates that you have with yourself about, this indicator says it should go higher, and this one says, well, I'm not sure, and then you've got another one that says something else. It clutters up your decision making to a large extent. And I found that the best thing I ever did in my trading is I took a whole lot and threw them away. And literally, everything that I'm showing you here, in fact, everything that I'm going to show you today, you can trade without a single indicator whatsoever. You don't need it. And by taking away all of this unhelpful influence on your thinking, I find actually makes trading decisions much simpler. I'm going to show you an indicator that I use in a rather unconventional way for a specific purpose. But what I'm trying to get to is you don't need them, and please don't get too hung up about other indicators and the power of indicators, because you just don't need them. When we let's crack on with looking behind the chart and take that auction process further and see how that's going to help us identify what's going on behind the chart. First of all, high volume market. Somebody asked me in a coffee break, can we apply this to any market? And the answer is, to a large extent, yes. You can use it in commodities, you can use it in stocks, ETFs, Forex, anything where there is volume. Where it will fall flat on its face, as most things will, are if you've got really thin, if you've got some bizarre stock that trades 2 or 3 times a day, there's no volume, it's not going to work there. But to be honest, probably very little is anyway. So stick to high volume markets. And my reasoning for sticking with high volume markets is simple. Think about markets in terms of people and the predictability of people. One person in a room could behave in a whole range of different ways and is highly unpredictable. Okay? A huge crowd of people become much more predictable. We know that, don't we? Just by observing life generally. And the larger the crowd of people, the more predictable the crowd itself becomes, because the actions of any individual become diluted by everybody else that's involved in whatever the activity is. And the same is true in the markets. So by sticking to high volume markets, you take away the outliers who can artificially influence things, because in the case of the markets, they are making a disproportionately large contribution to whatever is going on. So big crowds, big volume markets, that's what we want, to take away the outliers and try to focus on what's happening on average. Now, markets move in waves, up and down, all day long, every day. We know this, we see them. The market moves up, market moves down. The market, whether it progresses up or down, depends on the relative size of the most recent swings. Yeah. So it's no secret to say that that the market moves in swings and waves. What I like to think of are sort of pauses. When people talk about retracements, they are effectively pauses in the progress in any one direction. That originally we said that the premise at the beginning was what we want to know is when a valid retracement comes along, we want to use that as either a means of entering the market in the direction of the swing that we think is unfolding, or if there's reason to believe that pause is actually not a retracement, it's potentially a reversal, what we'd like to do is to treat that as a reversal and start looking in the other direction. Yeah? Now, the difficulty is, we don't know which that is until after the event. Right? That's pretty clear, isn't it? I mean, everybody can see that's a retracement, everybody would like to get in there and short it, and everybody would like to see the swing continue to its full duration. But at this point, which is it? And they look very similar. And I'm sure I'm not the only person in the room that's had this dilemma, and many, many times. Okay? And that's what we're going to work on today, and try and fathom out how you can identify a lot of the time which things that start to look like retracements actually are, and which ones are suspect and potentially reversals. What I need to talk to you about is what I call the theory of the two-sided market. And that a two-sided market will determine whether or not you are looking at a genuine pause or retracement, or if you're actually looking at a point of exhaustion. Before I come on to the two-sided market, first of all, what I call a one-sided market is a situation where you've got either supply or demand significantly out of balance with the other side. Okay, so you've got a lot more demand, very little supply. You're going to go through this auction process, the market's going to move up. You've got a one-sided market to the other side. To the downside, if you've got a lot of supply coming into the market and not very many people keen to actually buy this, you're going to find that auctioning process that we spoke about earlier. The opposite effect, the market starts to auction its way down. So effectively, what I call a one-sided market, where supply and demand are dramatically out of balance, that's what creates a swing. Either a swing up or a swing down. Make sense? Yeah? Now, a two-sided market is different. If what you've got in a two-sided market are much better balance between supply and demand, they're never going to be perfectly equal, but they are going to be orders of magnitude the same. So you've got as many people sitting at both sides of the table in the two-sided market. And what happens is, as price ticks up, the seller says, "Oh, these are good prices," and they actually sell, push it back down again. Price ticks down, the buyer say, "Oh, that's good. We're going to buy a better price," and push it back up again. So you get this sort of process where you've got think of people as being literally two sides of a dining table. And what they're doing is moving food backwards and forwards between themselves, and effectively carving out this pause, which is caused by both types of participant being at the table at the same time. And that's what causes you to see a pause or a retracement. That's what causes a retracement to form. If the market's been coming down, as we saw in that earlier slide, and we start to see a pause develop, the reason we're going to get some sort of retracement back up is because the market is actually overstretched to the downside. Effectively, supply and demand are pretty much the same. Okay? So you're not going to find the market snap straight back up. Whereas if it was a one-sided market, the selling's all been done, the sellers are finished, then there's nothing to stop it popping straight back up. But in the case of the two-sided market, we've got both parties pretty much equally spaced on either side of the banquet table, and they're just going to kick it around between them for a bit. And then ultimately, you can expect that retracement to continue in the direction of the swing that's currently unfolding. So, how do we identify one-sided or a two-sided market? To some extent, already described it. You can actually see the interaction between both of these parties. If you watch the current bar as it forms on the chart, you can't see this after the fact, only on a live chart in the current bar that's forming. What you will see is that rather than coming down, 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 or up, 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 which you would see if you were looking at the live market with a one-sided market underway, what you will see with the two-sided market is the market ratcheting up and down. Okay, it's not moving linearly in one direction. The problem is when you look at a chart after the fact, you're not seeing that live bar forming. So you can only see this on a live chart, and that's effectively, Jeff and I discussed this right at the beginning. When you're actually trading over a period of time, this is something that you just observe, get the feel for, and it's almost like a sixth sense. You don't realise until you actually start to analyse why this is the case, that you actually get a feel over time. It's all about screen time, years of actually watching and understanding, that you can actually tell in advance whether this is genuinely a retracement that's forming or if it's suspect. And the reason is because you're actually looking at the current bar that's forming on the right-hand side. You just don't, most people aren't aware that they are acquiring that sort of experience and that sort of knowledge. But what you'll find is very quickly that if you start to look for this, you'll find that you don't need the other way of looking at it, which is what I'm going to show you here, which is the cheats method. This is how you home in on it quickly until you develop that eye for watching the current bar forming, and that is to use a second chart, a much smaller time frame. And I'm not talking about going from a 30-minute chart and using a 15-minute chart. We're talking about using a 15-minute chart and using a 1 minute chart, something dramatically smaller, to help you break down that current bar, to actually look at it and understand what's happening during the formation of that bar. And if you think about it, take that 15-minute, 1 minute combination as an example. Your chart, your dead chart, after the 15-minute bar is closed, all you see is just one bar. It's got an open, high, low, and close. You know that. If you break that down by using a 1 minute chart as a microscope, you can actually break that down into 15 little bars, can't you? Right? Just simple stuff, this. But what that will show you, which your 1 bar on your 15-minute chart will not, is what's actually happened during the course of that 15-minute bar being formed. So use a second time frame as a microscope that is dramatically smaller, and I suggest at least a tenth of the size of the market that you're normally trading on. And you can use that as a proxy for the experience, which will come to you very quickly when you start watching this. But in the meantime, this is how you actually look at the market and understand, and also how you can look at markets after the fact, so that you can go back and look at historic charts and understand what's going on. What you'll find is a two-sided market will do exactly what I've just described. It will not be a retracement that moves in a straight line. It will have a lot of ratcheting type action. Market goes up, gets pushed back down, goes up, gets pushed back down, goes up, gets pushed back down. You'll see and feel this interaction between both sides. Whereas if you have a one-sided market, basically it'll just move in one direction. And you'll be able to see that on your microscope. You won't see that on your 1 bar that's forming on your main time frame. Your microscope will show it going blah, 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 down. There won't be any ratcheting type action. It'll be very clear that only one side is really at play in the market at that point in time. You see a retracement forming, and your microscope shows you linear action. Be very wary, because the chances are that what most people will look at as a retracement is a reversal. That's when we start to look in the opposite direction. Most people will actually be trying to play the retracement because we like retracement trades, don't we? All of us do. So that's how we differentiate between the two. When I show you some of the examples and take you through the trade setups, what you see is that this is really very clear cut if you study it. And you'll be surprised how quickly you can pick up this technique and really use it to filter out trades that are likely to do what your setup or my setup tells you they should be doing, and those that you really want to give a wide berth to and just let everybody else play with. And you can filter out an awful lot of losers just by using this simple technique of a microscope. Combine the information in both of those charts, and then you can make that decision as to whether or not you want to take the trade. So that's what the microscope will show. This going up, being pushed down, going up, being pushed down, all this kind of ratcheting action. Whereas your microscope will be very, very linear when you're using a smaller time frame in a market where it'll get to the same point. Don't get me wrong, the retracement will still be a 38% retracement if you believe all that stuff. It'll get to the same point. But what it will not do is actually turn and continue. The difference is all you'll do there is you will short reverse and retract it. In terms of time frames and which time frames combine, a factor of 10, I said, is probably the best rule. Easy to do with tick charts, with time-based charts. Order of magnitude. It doesn't matter if it's 10 times or 8 times or 15 times, as long as it's not going from 5 minutes to 15 minutes. That's not enough to show you any more information that you'll get in the main chart. These are the sorts of time frames I personally like to use, sort of daily, hourly, and 5 minute. You can use any of them. And also play with them, because you'll probably find that in some markets, for example, some markets that are much more active during the 24-hour session, you'll probably find that something like a 120 chart is probably it's good to trade dailies off and use 120 as a microscope. If you've still got markets like the grains where the overnight activity is is relatively small compared to the pit session still, then you might want to sort of think in terms of an hourly chart there rather than the 120. So it will vary a bit from market to market. Play with it, get a feel for it, and find the time frames that show you the information that you really need to see. Now, I said earlier about my loathing of indicators, which is just from having spent so many years being told that this is the new indicator, this is the thing that's going to solve your problems, and actually I've never found one that does anything other than volume. There is one indicator I use, but I use it in a slightly different way, and that's a counterband. What I find with counterbands is I use them as a means of telling me when the market is genuinely making a move, or it's actually just chopping around in noise. So I use it as a type of volatility filter, in the sense that all the time the market is unable to actually reach an outer band. I just regard that market as being what I call neutral. It's not going anywhere, it's not doing anything other than a bit of random movement. No doubt that random movement is there to make you think this is about to pop up so that you buy it up there, or it comes down here and you think, it looks like it's going to go down, I better short it there. If it's really not got enough energy to either side to reach an outer counterband, it's best just to leave it alone, or just consider that's some sort of range-bound market. Therefore, you certainly don't want to be looking for retracement type trades, but possibly you might be wanting to, if you're desperate to trade, you might be wanting to look for sort of mean reversion type trades. Before anybody asks, actually, I use 2.5 ATRs as the band setting for the Keltner channels, and the EMA around which the bands are set, that can be pretty much anything. I've used 13 periods, 15 periods, 20s, 21 I've got on here, can be 25. Actually, it doesn't matter at all what moving average you use, just pick one and stick with it. Because if you put all these different moving averages up there, you'll find that they pretty much end up in the same place anyway. But what matters to me is the distance that the band actually set away from that moving average. And I like to use a minimum of 2.5 ATRs, which is probably bigger than most people would normally use with counterbands. And my reason for that is I really don't want to trade unless I think the market is genuinely going to do something. And therefore, by making it really stretch to reach those bands, it gives me an immediate visual alert to say, okay, things are now starting to wake up, and now I can consider trading. But again, you can play with those between different markets, different time frames, and find what settings that you like. Now, the reason I use these is because on the smaller charts, it just gives you a very quick visual check. Bear in mind, I've got 14 screens around me in my office when I'm trading, and it's difficult with 2 eyes and 14 screens to actually be catching everything all of the time. So this is one reason why I say I can trade all of my stuff just using a bar chart. I don't need any indicators, but by having these things, you can set alerts, which will tell you, you need to now look at such a market because it's now reached a Keltner band, you've now got permission to start trading that market, then you can start making the setups. If you trade one market in one time frame, you don't need any of this at all. But for me, it's just a useful guide to actually alert me to the fact that the market is starting to come out of neutral, starting to come into play, and it's now worth starting to look for entries. So in this simple example here, we tag the Keltner band to the bottom, which gives us suggestion that supply and demand are now coming out of balance sufficiently for us to be thinking about wanting to play with one side in a trend following type of trade. So here we've got the beginning of a downswing, a pause potentially in the middle, and what we're trying to do is capture the rest of that downswing. So that's what retracement trading is about, isn't it? Yeah? So until we see sufficient movement to the downside or the upside, we don't want to start thinking about that as a retracement necessarily. Once we hit the lower Keltner there, we say, okay, now start looking carefully. Get your microscope out. Have a look at this retracement. Understand whether that is a one-sided market or a two-sided market, and then you can decide whether or not you want to short it. And if you do, there's a potential entry there, which we'll talk about how you would identify that as an entry a little bit later. But potentially you've got your first retracement trade there in what we hope is a new swing. Okay, so that's how I use a counter plan, just to help me quickly identify things when I'm following lots of different markets. And I called this chart number 1 for no other reason other than it's the first chart, but also because I want to come back to that right at the end, because I'm going to show you something which you may not be, at this point in time, be able to identify very easily, but by the time I've finished going through this, you'll be able to see exactly the difference between a pause and a reversal. So I just want to draw your attention to the fact that we're going to use this chart several times. Plenty of other charts too, but this one we're going to come back to. What you can see here, again, the same chart, we've had a first retracement, little pause in the middle of the downswing. And if you look at this potential retracement at the bottom there, on our normal time frame here, do they look about the same? Do they look very similar? Yeah? Would you look at that normally with your one chart and say that looks like another nice retracement? Yeah? By the end of the presentation, you'll be buying that, not selling it. Okay, so bear with me. It may be basic stuff, it may be simple stuff, but it's very powerful stuff. We had the downswing, we had the pause in the middle, and then no more continuation. What we had there was a reversal. We had a reversal in there because this potential retracement is in fact a one-sided market, as you'll see in a minute. And that's the reason why you would not want to short that. You may not want to buy it because you'd look at that and think, oh, I don't really want to be buying that. Fine, there's nothing wrong with that. I'm not suggesting everybody should trade against what looks like a new trend, but you certainly don't want to be shorting that. And you'll see why shortly. Right, let's talk about using this then in some very specific trade setups that you can apply. As I said earlier, you can apply this filtering technique to filter out good trades from bad on just about anything you're doing yourselves. I'm giving you 6 entries here so that you've got something that you can take away and start working with for those that perhaps don't have their own trading strategies, but don't just stick to the ones I'm going to give you here. Just use this and apply it in your own trading, whatever that may be. What I'm going to do is I'm going to take you through basically three setups: a retracement trade, what I call a new swing trade, and a reversal trade. And I'm going to give you 2 possible entries, what I call the conservative entry and then the more aggressive entry. And the benefits of each of these are the conservative one gives you the highest winning percentage of trades, but you'll be entering at a slightly less good price. The aggressive entry will give you a better risk reward, but until you're used to using this, the risk is that you get a lower percentage of winners. So what I suggest is that in starting this, you start with the conservative entries, become comfortable with them, become familiar with them, and only then, once you've got the feel for them, start being more aggressive in trying to enter at better prices. And then what you'll find is, ultimately, you'll find that your percentage of winners on the aggressive entries will probably not fall very, very far behind the conservative ones. But at the very early stage, if you try and take the aggressive entries before you've really got a feel for this technique, you'll find that your percentage of winners is a lot lower than we would like it to be. Likewise, I suggest retracement trades are probably the place to start. Reversal trades are the most aggressive trades. I actually like them the best because they're the scariest ones. But I say that in all sincerity, because they're the scariest ones. Who else is going to be stupid enough to want to take them? Because you're not competing in the same way. Okay. So I find actually there are far fewer of these, and I don't generally recommend people trading against the trend, but there are times when that's the thing to do. So to basically start to work through this sort of pack of 6 cards, one by one, and just become more familiar with the ones get more conservative entries and then expand it a bit. What we'll find will happen is that you'll probably gravitate to one or two of these trades, which may be more in keeping with your own personality as a trader, and you'll just focus on those and do those, which is great. But that's the reason I'm giving you all three and two different types of entry. I mean, John is a friend of mine here who is naturally a contrarian. So he likes. I beg your pardon. He likes this particular trade, and in the last few weeks has been becoming something of an expert at it, because he likes to go against the trend. And actually, given the choppy markets that we've had lately, that's probably no bad thing. But you just need to recognise that that is a much more aggressive form of trading than trying to go with the existing trend, however may be left. So I'll give you the whole lot. Play with them, find the ones that you like, and become a master of one or two rather than saying I've got to learn all six. Okay? And I think that bottom point is actually extremely important. I was talking to Brian at the front just when we had the day, and I said above everything else, and it doesn't just apply to this, but all trading strategies that you use, just look for the best, the cleanest looking setups. And be happy. If you're not sure about it, it doesn't look clean, just stand aside, it doesn't matter. There are plenty of trades coming. Just try and pick off the choicest looking ones and not out of frustration sort of look at the setup and well, it's kind of there, but because I'm bored, I'll take it. Don't. Best thing you can do is just stand aside. You'll miss a few winners, but just if you try and focus on the best looking ones, in the long run, you'll be pleased for standing aside on a lot of the dubious ones. So look for clean setups all the time. Right. I talk about trading with the money as opposed to trading with the trend. And what we're trying to do in getting this gauge of supply and demand is to say, well, all the time that the supply and demand balance is in the direction of the trend, we want to be looking for retracements and try and get continuation type trades. But I'm not worried about trading against that trend if the money is shifting to the other side. A bit like George was saying earlier, some of the charts he put up were vicious looking reversals, sort of E-type reversals, which most people would have said, I don't want to touch that. But George had reasons for wanting to go against those trends. And in my own way, that there are times, with what I'm doing here, where I will actually be quite happy to trade against those trends. But I tell myself, you're trading against the trend only until the trend actually reverses, but you're trading with the money. So that's how I justify trying to do reversal trading as well as retracement trading. But in all of these, we start off with the pause, which kind of looks like a retracement type of pattern forming, and we use our microscope to zoom in on it and understand exactly what's happening during the formation of that retracement. So they all start off the same way. If we can see it's clearly a two-sided market with this ratcheting action visible, moving up, moving down, moving up, moving down, and you can see both sides of the party sitting around the table, then we treat this as a retracement trade and go in the direction of the swing that we think this is a pause in the middle of. And if you pick off the clean ones, that swing you will find will continue quite high percentage of the time. You should 70-80% accuracy if you actually focus on this and only take the cleanest looking setups. The other end of the spectrum is the very obvious one-sided market, where you look in your microscope and you see, hang on, there is actually only one type of participant in play here, and basically you're looking at an exhaustion situation. You don't see any ratcheting action. You see a very clear linear move onto your microscope, and then you know that what you think might be a retracement, or most other traders would think is a retracement, you're actually going to be looking to go the other way. And that's where you look for your reversal trade. And as I've said there, the reason I like it, it's got a lower hit rate, but a much bigger profit, because you're effectively, when you catch them right, you're basically entering a new trend before anybody knows there's even a new trend about to unfold. That's why the risk reward can be dramatically better. But you've got to accept, you're going to get stopped out more times in the attempts that don't work. Now in the middle, we have a situation where you can have a mixed picture. You get your microscope out, you have a look at what's going on under your microscope, and you see that there is some evidence of two-sided activity, there is some evidence of linear move. You've got two options here. You can either stand aside, or you can actually wait for your microscope to show you the activity that you're actually looking for, to tell you that the move, which is either going to be a pause or it's going to be sort of a small swing in the other direction, you just wait for it to develop to the point where you can see both sides in play. So let's, for example, imagine you have a situation where the market's been going up, you start to see some sort of pull back down. Your microscope says, well, this is a linear move, be very careful about buying this. Then you start to see some ratcheting action at the end of that move back down. That's telling you, hang on a minute, the buyers are now starting to come back in at this point. Therefore, potentially, that's a little swing down, and I am now prepared to start looking to move in the direction of the previous swing. But until you see both of those sides at play, don't buy. Basically, don't buy a falling dagger, which is what your microscope will be showing you. Okay? Yeah, when there's doubt, just stand aside and wait for the next one. Just to give you an idea, this is roughly the sorts of proportions that you would see over an extended period of time. Perhaps about a third of the potential retracements are retracement trades that you should take. Something of that order. And if you are a retracement trader only, be happy to step aside from the other 2 out of 3 and just leave them for other people. Probably as little as 1 in 10 will be reversal trades. Okay, and that's a reason why you only want to be looking at reversal type trades once you've got some experience with this, because you don't want to be taking a 9 out of 10 which are going to stop you out. Makes sense? So it comes with experience, and that's why I recommend starting, moving with the trend, trading with the trend as well as with the money. Whereas here we're trading against the trend. I claim we're trading with the money. In the middle, perhaps as much as 50 or 60% of them will show mixed activity, and that's why you need to actually be thinking through what your microscope is showing you in the context of what you're looking to do, and possibly you will then pick up a new swing. And when I show you the entries, you'll see exactly what I mean by that. Simple retracement trade. Here we have a situation where we've got markets neutral, going nowhere, suddenly it comes down, tags the cap and starts saying, hey, look at me, I might be ready to start playing. We see a nice little retracement there and a possible short opportunity. Boom, off it goes. That's exactly what we're looking for, right? Now, what tells us that that is a retracement rather than just a reversal? And the answer is, you see this type of ratcheting action I described? Under your microscope, this is a 1600 tick chart, and that's a 200 tick chart, 8 times smaller. So what you're actually looking at there is this little series of bars that make up the retracement, and you can see it goes up, gets knocked back down. That means there are sellers still around. It goes up, gets knocked back down, sellers are still around. So you see this ratcheting action that says, okay, this is probably a decent retracement trade that's worth going for. So we would trade that as a continuation pattern in the expectation that this is a new swing that is starting. In this case, of course, it is. I'll come back and I'll show you the sort of entries that we can use. Because, there are, as I said, there are conservative and aggressive ways of entering these trades. So this is our main, main trading time frame. What the aggressive entry here would be to try and sell basically at the best price. As soon as we see some evidence that the retracement is over, and by evidence I mean you've got a series of bars here, 1, 2, 3, 4. You've got 4 or 5 bars there that have basically hit a point where they're not going any further. Doesn't mean they're not going to test higher, but there is evidence that that retracement may well have now run its course, and therefore your aggressive entry would be to try and short that at the best possible price that you can get. In which case you're going to put a stop a little bit higher. I suggest you don't put your stop right at that swing high, because you don't know that's a swing high until after the event. Okay, so give it a little bit more room, maybe you'll get 2 or 3 bars that test up a little bit higher just to make sure there are no stops up there before it continues. Anybody experience that? Right? So if you take aggressive entry, give it a little bit more room than a lot of traders will. And if it breaks straight away, great. If it tests up a bit, fine, you'll still be in the trade. If it gets up to here, that's not exactly going to be the greatest retracement trade in the world. So just take a loss and move ahead. The conservative entry, which is where I suggest most people start with this, is to actually sell weakness in the direction that you're anticipating the swing will continue. And what I like to see is a bar close, not just a spike down, but a close lower than, basically at this point where you see that bar close, if that retracement is genuinely a retracement, you have now created that swing point. If you're not, it's either going to continue or it's not. In which case you can put your stop, you can use that swing point as the location of your stop. Because either this entry trigger is saying, right, I am a retracement and I'm now on the next leg of my journey, or you want to be stopped out for the minimum cost. So that would be your conservative entry. Wait for the turn down, wait for a close. That's the important thing. Let's get a bar close there, and then use that close as your entry point. Just go in at market. Okay, so that conservative entry and aggressive entry on a retracement. Okay, let's talk about the other extreme, the reversal trade, the fade trade. Here we have a situation where this market has been going sideways. It's a bit sloppy. This is just after the open. That looks like the open of the day, so this is probably next session or something. We've got the market running up. It's tagging Keltner. It's saying, come and play. I've deliberately picked one here that you can almost see on our main time frame as a pretty linear move. Okay, they often look much more like retracements for me. But even on our normal time frame, you can almost see those 3 bars are coming down pretty hard, aren't they? Don't want to buy that because that is classic reversal. There will be systematic traders, and John and I and 1 or 2 others just love these entries because what will happen is a lot of people who run sort of systematic trend following type trading systems, they will use something like a moving average as a place to buy. We like to allow them to buy and sell. So what you see under your microscope here is 0 ratcheting action whatsoever. Boom, 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 straight down. Are there any buyers there? Is there any evidence of any interest to the alongside there whatsoever? Or has that market just exhausted itself? Because what's happened is all the buying has now been done. Nobody's interested in buying that, other than possibly some systematic traders. So what we do is we identify that as a potential reversal trade. And actually the moving average is irrelevant, but you'll often find the moving averages when some activity starts. It doesn't matter again whether it's 15 or 20, 25 period moving average, whatever it may be. You will often find activity around there because computers are programmed to use moving averages as entry points. So our microscope says, look, this is a one-sided market. There is no evidence whatsoever of any buying. We don't want to be thinking about buying that as a retracement. What we want to be doing is thinking about this as a means of going in the opposite direction. So having identified that is the case, we've got 2 possible buyers, one conservative and one aggressive. The aggressive one here is shorting the first little tick up after the linear move down. Okay, I don't really, in theory, you can just short it as it comes down. I actually like to get a little bit more for my money because we're going against the trend, because I don't really want to be shorting down here and using wider stop than necessary. I do like to get a little bit of a bounce. That little bit of a bounce is caused by the computers buying moving average. So when we get just a few ticks lift from there, then we will short it. So we're basically shorting any few ticks that move up. And in this case, the swing high will be our stop location. And the reason for that is simple. Unlike the previous case, this if this is a genuine reversal, that must already be a swing point. Okay, so I don't need to put a stop up here to be told I'm wrong. I can just use that swing point as my stop location. I don't need to get any more room than that. So there's my aggressive entry. The conservative entry, which again I suggest is where most people want to start. The conservative entry comes when the market actually starts breaking down below that linear move. So your microscope has shown you a linear move down. After the linear move, a little bit of a tick up where you're moving average boys come in and buy. When it comes down and breaks back down below that previous bar, that's giving you confirmation that this market is now going in the opposite direction. The computer traders who loaded up there, they're now going to be in a world of hurt, and at some point they're going to have to get out, and that's of course going to accelerate the move to the downside. So John, being the evil person that he is, always likes to think about who's got caught on what side of the market, but there is some logic to that. So our conservative entry is wait for it to break back down below that first linear move, and again, I want to see a close. I just don't want to see a spike, I actually want to see a bar close down there, and then I'm going to go with it. And on this occasion, we can use a stop that is sort of around the area of that first little push up where the systematic traders pushed it higher. You don't need to give it away to the swing point. You can just give it a little bit less room than that. And so that would be your second entry point, or conservative entry point. Once it's done its thing and it's now proving it's going to go in the opposite direction. The third type is what I call the new swing trade, and here you have a situation where you've got a pretty uninspiring looking market. That's sort of a market that is slowly drifting nowhere, and you know what, I wouldn't be in a hurry to buy that retracement personally. But what you will find, if you look under a microscope, which is what you've got here, you will see a linear move down. So you might be thinking, well, maybe I should be shorting this. However, at the end of that linear move, look what we start to get here. A little bit of evidence that there's some support coming and some buying coming. So if you were inclined to want to take that trade, then basically wait for the linear move to end. Let there be some confirmation under your microscope that little swing down may have run its course, and then look to buy when the thing turns back up. So that would be what I call a bit of a swing trade as opposed to a retracement trade. Now the difference here with the entries is that on this particular trade, you use your microscope time frame actually to trigger your entries. Previous ones, your entries were governed by your normal trading time frame. Here we're using the actual microscope to give us our trade entries. And the aggressive one, if you're wanting to trade this as a new swing, is basically to be buying weakness once you start to see the evidence of the other side of the market coming back into play. In this case, the buyer's actually stepping back in and managing to support it, as it pushes down. The more conservative entry, which I must admit I would prefer in this situation, is to wait for that to actually break back up. You've got your linear move down, you've got your ratcheting action here, which says, hang on, maybe two people playing this market now. Let them prove it. Let that move up. Let that break out above this little sort of boxy zone here, and let the market close up there, and then use that as your entry. You've got a swing point there, which is actually, bearing in mind this is your microscope, that's going to be a pretty tight swing point. You're not going to be risking a lot of money on this. So your conservative entry will get you in there when it breaks upwards. Your aggressive entry, just give it a few ticks below where you think that ratcheting action is demonstrating something important is happening. And those are your two entries for the new swing trade. And as I say, there will be, when you get used to looking at the tiny time frame here, you'll find that a lot of the time there is sort of mixed evidence of linear moves and maybe two-side moves. And that's why I say sort of 50-60% of the time, it will not be clear-cut. The clear-cut ones we jump on, no question, we deal with them. these ones in the middle, it's a question of whether you actually want to be doing these, or simply say, no, I'm actually going to do the retracement trades, or I'm going to do reversal trades, and the stuff in the middle I'll leave alone. If you have to trade, you want to trade, this is how you capture the end of a potential retracement that is giving a mixed picture. So then, this is the question, which of those do you want to do? Aggressive or conservative entries? And I know there are people here who are going to... No, I'm not even going to go down that. I said my recommendation is you start with the conservative entries, and then as the experience builds, you then get on to the aggressive one. But here's the thing. How about doing both of them? How about doing both of them? Why do I say that? The reason is, if you go back to these charts later today, and you look at where my stop locations are for each of the conservative and the aggressive entries, what you will find is that by the time your conservative entry triggers, your stop for your conservative entry will be at pretty much the same price as your aggressive entry price. Okay? So what that means is that if you've already taken the aggressive entry, your stop is now at break even. If you then take the conservative entry as well, worst case, if you've got 1 unit of risk. Yeah? 1 unit of risk, but you've got 2 positions. Now, isn't it great to have twice the size on the trades that really motor and win, but only having 1 position on for those that fail? Just think about what that does for the the dynamics of your trading statistics. And what I can tell you is that you will not get a conservative entry if your aggressive entry has failed or stopped you out and it's cost you 1 unit of whatever your trading size is. The best trades, by definition, will trigger both entries, won't they? So you might want to think seriously about taking both. But once you've got used to both types of entry, I'm not suggesting anybody rushes out one morning and says, right, I'm going to start trading 2 units and I'm looking for a cheap price and then I'm looking for confirmation. Build it up slowly, get used to the experience of, I recommend the conservative entries first, get a feel for how this works. As you then develop the experience and prepare to start taking the more aggressive entries, then there's no reason not to take both. No reason whatsoever not to take both. And in fact, that's what we've started doing. And the best trade that we had in the last couple of weeks was exactly that. We ended up with 2 units on. The trade worked perfectly, but there was never more than 1 unit of risk. So it was great. And we're going to be doing this a lot more from now on. John's sitting there not. And in fact, was that a fade trade? I can't remember now. That was on the S&P, wasn't it? I think that was a fade trade as well. So that gives you the best risk reward anyway when it pays off. And when it pays off to have double the unit size on, that's as good as it gets, folks. Now remember where we started. Just to go back to where we started. Remember this chart number 1? And what we said was these sort of potential retracements to most traders look very much the same. The difference is that's a nice winner and that's not such a nice outcome. But now you know what to do when your microscope tells you that this is a one-sided move. Hello, what's going on here? Whoa, something's gone wrong with my slides here. You've got a linear, your microscope will show you that you've got a linear move off the low there, which most people won't spot. What you'll find, you'll see this is a classic reversal trade. You've got, around that area of the moving average, you've got the computers coming in and shorting it. They push it down just a few ticks. That's where your first entry is, your aggressive entry to the long side. If that fails, you're not going to trigger your conservative entry up here, so you've only got 1 unit of risk. You get your conservative entry and boom, you've got 2 units on, 1 unit of risk. And that was the chart that you started seeing at the beginning. I'm sorry, I don't know. I assume I had the microscope up there, which something's gone wrong with the computer. But basically, what you will find is that's the one-sided move. And whereas all the other traders are shorting this, you're actually buying this and potentially buying 2 units of it. And so that's what I call the secret of looking behind the charts. So how are we doing for time? Hey, 12 o'clock. Yeah. To the minute. Thanks very much.